9 a.m. in Shanghai, Shenzhen, and here in Hong Kong, you're watching The China Show. I'm Yvonne Man with David Ingles.
Good morning. We're counting down to the open of markets in Greater China. Our top stories today, stocks across the Asia Pacific under pressure after this rotation out of tech, dragging Wall Street down. Software makers plunging on a threat from Anthropic's new automation tool.
That rotation also gathering pace here in Hong Kong, pushing tech stocks to the brink of a bear market on concerns over valuations and earnings prospects.
Also ahead, oil gaining as the U.S. shoots down an Iranian drone in the Arabian Sea. But President Trump says diplomatic talks with Iran are continuing.
And we hear from Indonesia's finance minister as he defends his government's economic track record after a slump in the currency and stocks. Just when we were talking about calm yesterday, it seems like we're back to talking about AI.
Yeah.
But this time it seems like it's a bit different in this sell-off, right? It's not just about what we're seeing, whether AI plays out in earnings and the like, and whether we're seeing, the ROI and all of this investment, but really about what could it actually disrupt in terms of industries, right? And I think this Anthropic news on what it means for software companies, data-adjacent companies, certainly leaves a lot of question marks here now. What's to come in this industry, really?
It's sort of borderline existential threat.
Yes.
And I think the Goldman basket of software stocks was the big headline that dropped as we were waking up here in the Asia Pacific, down about 6%. I think the most since April of last year. And that goes into, we had to put the move overnight on the back of the big move in Korea yesterday, right?
Yeah.
Where you have a 10% move in Samsung, which is why you're getting rocked in a lot of these names. You know what I miss? I miss sub 1% moves. I realize we haven't had a normal day so far this week.
They're talking about precious metals. I mean, they're like, it's almost like a casino these days, right? When they're trading not like safe haven instruments, but really like meme stocks.
Right.
When is it all going to settle, right? And then certainly you continue to see that here when it comes to precious metals. But then again, you talk about what's going on in tech.
Yeah.
And in Hong Kong, we started to see a lot of that pronounced selling on so many rumors about VAT. And taxes when it comes to the telco sector. That was confirmed, but then it kind of spread that maybe this is going to be coming to the internet companies and the like, and then of course rumors kind of usually flame the fears out there right now too.
Yeah, rumors are all that are needed at some point, and then there's the EV component too, when you look at the drag on the Hang Seng Tech Index, right?
Yeah.
So we are very near a bear market. We'll talk about the specific levels to watch going into the session today. So there are two levels to watch. We're very close to both. The second one would take us into a bear market, which is 20% down from the October 2 peak. So we talked about how we missed sub 1% moves. And so we're down 1% on the Nikkei. We are getting, thank you so much on the Kospi Index for giving us some anchor today. Half of 1% down in the open in Taiwan. NASDAQ futures are still somewhat, but that's extremely small move, though, under pressure, 30 points to the downside. Right, if you're curious, the big names coming through, TSMC, Samsung, SK, and Laser Tech in Japan. There we go. As you can see, not quite, of course, the reversal of yesterday's massive gains, but we'll see. The night is young, right? Silver, gold, you have oil. We talked about Iran, and you had Bitcoin back to 75, 76,000. What happened to Bitcoin is the question we're putting there. Right, one of the things, too, we'll talk about later with BofA. So they're still bullish in gold and gold miners specifically, and we'll talk about all these regulatory changes in China. This widening, for example, the exchange overnight talked about the trading limits on silver futures onshore. Dollar was stronger going into the session today, still strong. So we're up on dollar yen to about 156 now, as you can see on your screens. We were up on Aussie and the Kiwi. Going into about a couple of minutes back. Right, the approach to the open today, A50 futures, you have copper coming online. There we go. In Shanghai, 3% to the upside, and dollar China 693 there against the 693 is the exchange rate for today.
Yeah, in terms of your agenda, you talked about the levels that we're watching for HSTECH. We were on the cusp of some sort of bear market yesterday. We'll see if we make it there today, but certainly there are signs that maybe this whole AI trade is unraveling once again here. So maybe that could be leading to some weight on this market. In terms of metals, continues to be the whipsaw that we're seeing across precious metals, and what that means for some of the miners in the China plays there. Rare earths are certainly still a key focus. We're hearing news of the EU is also joining in on this whole, front of what the U.S. is doing about accumulating critical minerals and the like. Oil, given the Iran story, crypto has been talking about there. We have some data from Rating Dog. This is the non-manufacturing PMIs as well. Yum China also reports later on today. Sun Art Retail, there's news of the CEO. And they have lost contact with him. So certainly watching what that means for the stock here today. And there is going to be a CGB sale today. Yeah,
there will be that. So we'll see. I'm curious what Sun Art is. So we're looking right now, not a lot of movement in the extremely early part of the day. The company said it was unable to contact its CEO. Right. We talked about two levels to watch, just below the 5,400 level on the Hang Seng Tech Gauge. 53.97 is a level that's actually held the last 3 times we've tested that. Below that is the green line, just below 53.50. That takes us into bear market terrain, which would be 20% from the peak that you see back in early October. Right. Let's get a sense of flows and sentiment out there, given quite a manic week cross asset. Joining us here on set, Thomas Taw, Fidelity's head of APAC ex-Japan ETF distribution. Very nice to see you, sir. Happy New Year.
Yeah, Happy New Year.
It's not too late to say, Lunar New Year is coming
I
up.
thought you were talking about Lunar New Year.
Oh, okay. There we go.
Happy
I'm sorry to come too early. What's this week been like for you?
It's been volatile. The gold and precious metal moves was kind of the main thing.
Yeah.
A lot of questions on what institutional clients are doing in that space. For the most part, nothing.
They're sitting this out?
They're sitting this out, yeah.
Okay.
I mean, this has primarily been a retail, at least the last 15-20% has been a retail type move. I mean, if you look at some of the margin flows that have been going on in margin debt in the U.S., I mean, it was very clear that when we saw that sell-off last week, we were seeing a lot of stop losses that were coming through. Now you see a little bit of a push higher, dip buying going on in the ETF space. But, I think from an institutional investor perspective, like, you're not buying gold as a diversification play, right? So I think it's kind of sitting it out. And I do think this longer-term trade into the gold space, which was very bullish on last year, is over for a little while. Let's see what plays out, particularly with the U.S. dollar, U.S. exceptionalism, all this kind of stuff. But yeah, it's been bumpy, and I think the year of the horse, you're going to need a very comfortable settle because it's going to be very bumpy.
Gold, I think people still see the long-term sort of prospects for it. Silver is a different thing, right? It's not a reserve asset. It's much smaller and thinner.
Less liquid.
Yeah. So, should I be looking at silver very differently than gold?
I think so. I mean, silver obviously has some industrial usage, but for the most part, silver is gold on steroids, right? So I think what we're seeing in the silver space is again more on the retail type of investment, and what's been really driving gold up until the last 20% or the last couple of months has been the sovereign institutions buying gold as kind of a diversification away from just U.S. dollar reserves, and that's not the case with silver. So you don't have that institutional sovereign backing behind it.
I know you have some thoughts on last year was really about U.S. exceptionalism. Last year was the dollar. Maybe that's expanded to a slightly bigger narrative now. But before we get to that, just Bitcoin, because Bitcoin was supposed to be the basement trade.
Yeah.
What's happened there? What are you seeing as far as flows? Because you guys have a big ETF there.
Yeah, I mean, we're still seeing interest more in the high net wealth space, not so much from the institutional. I mean, the thing in institution has always been the same. How do I size it in my portfolio? And then there was a lot of questions like, is it a diversification play? Maybe, but the correlation to NASDAQ went up to basically 1. And so I think investors in the retail high net worth space are going to continue to buy it, but it's what do you think? What is it now? It's a debasement trade. It's a anti-US dollar trade. It's going up trade. So all these things, which is really the way that you shouldn't be looking at it. Like, I wouldn't be buying it just because it's going up, but because you can't put a valuation on it, you have to trade it on technicals. And so I think at the moment the technicals are pointing more towards the downside, but you'll continue to see dip buying in it. Yeah,
you mentioned the debasement trade and what this means for U.S. exceptionalism. Last year was a lot of concerns with the dollar.
Yeah.
Is it more than just the dollar now?
I think so, yeah. I mean, there was all this chatter about U.S. exceptionalism last year. We didn't really see it, right? I mean, U.S. dollar, yes. We saw a blip in March, April, and then everyone kind of moved back in. But I think under the surface, what's very clear is that buying just core S&P 500 is not working, right? So the good news is I think there's a lot of alpha in U.S. to be gained from single stock selection.
Right.
But just buying core S&P 500, which, again, this is very obvious, but I keep saying this to clients, is if the AI tech trade, if we see rotation into some of the laggards, the broad index will go down because that's the primary concentration in the portfolio. And so I think that's the biggest concern right now is like, yes, there's a lot of spending going on in AI infrastructure and there's probably more juice in the infrastructure trade, but spending more money is not necessarily a great investment play because your ROI is going to come down over time. And so you kind of have this arms race into infrastructure spending.
What about the Asia component to the AI conversation? Because Korea's given us a lot to talk about.
Yeah. I mean, again, I think Korea, a lot of this is being driven by retail flow. Okay. I think on the institutional side last year, clearly there was a valuation catch-up, particularly in some of the heavyweight tech names there. We saw that in China, we saw that in Korea. And it is, again, sort of that rotation away from just having U.S. tech in the portfolio. Yeah. But I think Korea is definitely one to watch. Gold is one to watch. Bitcoin is one to watch. And then obviously what the heavyweight AI tech names do in the U.S.
But are they quite vulnerable? I mean, just the moment that we saw the crash in precious metals, I think Korea was the first one to kind of feel the brunt of it. And it's wiping out a lot of crowded trades out there.
I think, sorry.
Go ahead. I mean,
no, I think what you're seeing is these little pockets of bubbles that are coming up. The gold was the most obvious example to that, and then you see a deleveraging in terms of something will happen. I think that the announcement of the Fed candidate Warsh in terms of his perceived views on monetary expansion or fiscal tightening, and then you see this kind of pullback, and then you see stop losses, and I think gold is a good example. Bitcoin, you're going to see a little bit of that. Korea is probably a good example of that. And then we'll see how the heavyweight tech names in the U.S. work. But I think this is one of the big reasons why you're seeing this big shift into the active ETF space in the U.S. is because it's very hard to actually invest in this environment, right, where you have so much volatility and tech factor rotations and sector rotations is so hard to do. And so I think institutional clients are moving more into that systematic active ETF space where you can get that single stock attribution.
When the dust settles, after all of this, the best opportunities you think, outside of single stock names, you think?
Well, the question is, when is the dust going to settle?
Okay, well, let's start with that.
I mean, short term, I would say I'm relatively bearish across the space. That doesn't necessarily mean that you should be going underweight U.S. equities. It just means you need to invest slightly differently than you have for the last 15 years. I think in Asia, the view hasn't really changed that much. I think it will be interesting to see whether you finally see A shares start to perform. That, of course, depends on consumption. But I've always said this, right? U.S. investors, foreign investors into China don't necessarily want to own it long term, and so you've seen this big inflows into ADRs and tech names, and now it's like, well, I'm up a decent amount, and like, let's see, let's rotate out, and then we'll see if that moves back into India, I think.
Are you starting to see any signs of that, given now that we have a trade deal with the U.S.?
Yeah.
And
not so much on the ETF space.
Okay.
I think the most interesting trade has been the big shift into EM as a broad region versus EM ex-China, which was the trend.
Yeah, that emerged last year, or 2 years ago.
Yeah. So I think January was the biggest ever inflows into EM ETFs, and then last year was the second biggest year other than 2017, which was that Goldilocks trade. So I think that will broadly continue.
Tommy, it's great to have you.
Thank
Thomas
you.
Talavera, head of ETF distribution for Asia Pacific ex-Japan at Fidelity. Still ahead, we'll be speaking with the BofA Global Research about why they think this year will be an auspicious one when it comes to electrification and AI power infrastructure. Matty Zhao joins us. What to next in terms of metals, precious metals alike?
Yeah, but ahead of that, Indonesia's, of course, been a big topic of conversation. We sat down, in fact, with the finance minister. Haslinda's conversation is coming up there. They're essentially shrugging off the fears of this MSCI downgrade. They are paying attention to the issue. It seems they're confident they'll be able to meet that. That conversation from the Indonesia Economic Summit is coming up next. And also, counting down to the open of trade in about 15 minutes or so, Shanghai, Shenzhen, and Hong Kong. And as we were pointing out, one stock specifically in focus will be Sun Art after the company said it is unable to contact its CEO. This is the China Show. Welcome back. Might be a good thing that we're trading sideways in futures given the route we're seeing in tech specifically, but it's also worth noting that tech in China had been leading the declines anyway, so this might be just a period of stasis. We'll see what happens. Fix it today's coming out, bottom of your screen, 695.33 against the US dollar.
Yeah, we're still watching Indonesia, of course, which we did see actually yesterday was a little bit better, right? The session on Tuesday, we did see a bit of a recovery of 2.5% or so after what has been a whirlwind of a week here after, of course, that MSCI warning here. So it was the biggest gain since April of last year, what we saw there yesterday. And certainly this interview that Haslinda did, it was quite interesting as well, and really kind of getting the government sort of perspective on what they're doing to stem the losses there as well. We'll have more from the interview there, certainly one thing to watch, because the finance minister says he's not concerned for now about the possibility of that MSCI downgrade here to frontier market status. Speaking to Bloomberg's Haslinda Ahmad at a business forum in Jakarta, Prabaya Yudi Sadwaya also told us why he thinks the index provider's warning is actually a good thing.
As I told you, the intransparency in the market was quite big. I've told myself to the stock market management at that several months ago to clarify the market from this cooking practice of manipulating prices of shares, but they didn't do anything. So to me, MSCI warning is a good thing because I can write them to clear the market practice toward the better.
Are you concerned about a possible downgrade?
No, because it's improving the condition. Unless we ignore the MSCI warning until May, then we have to be concerned. But I think the government and every market regulators have taken a proper approach to ensure that before May this year, we will satisfy what the MSCI wanted. So you should be okay. You should be fine. And I think in my country should be okay. We will follow, adhere to the global best practices.
You're expressing confidence, but there is a real risk of being downgraded by the MSCI. Are you prepared for that? What measures are in place that could possibly mitigate the impact of a downgrade?
No, we will satisfy all of the MSCI's, all of the things that MSCI wanted, including basic transparency. For me, as a Minister of Finance, I'm not involved in too much with what's happening in the boards, but I focus to ensure that the economy moving in the right direction. We make sure that our government spend enough money in the first quarter, second quarter in a timely manner, and we ensure also that there's enough liquidity in the market, and we are making sure that we are improving our business climate. We have this special task force of the bottlenecking, where every businessman can report to us, and on a weekly basis we have a meeting, a proceeding to ensure that the bottleneck that they are facing is removed properly. I think 1 year from now, we will have a different and much better business climate condition. That's enough to create a better and faster economic growth. Eventually, it will be represented on the increase on prices of shares in our capital market.
And that was the Indonesian Finance Minister Prabaya Yudi Sadewa speaking with Has in Jakarta. Now, some other stories that we're tracking for you today. Oil prices are on the up, even as President Trump says diplomatic talks with Iran are continuing. Now, it follows a spike in tensions after the U.S. Navy shot down an Iranian drone headed toward an American aircraft carrier in the Arabian Sea. The White House has confirmed that U.S.-Iran meetings involving Trump's Middle East envoy, Steve Witkoff, are still scheduled for Friday. The partial U.S. government shutdown has ended after President Trump signed a funding deal negotiated with Senate Democrats. The agreement extends Homeland Security funding through February 13th, while the rest of the government is funded through the fiscal year. Some conservatives backed the deal after pressure from Trump, while several Democrats opposed it over immigration concerns.
Right. We're going into the open today, about 8 minutes away, so we're let's call it sideways to flat. This really might take some time, and just keep in mind we're coming off quite a dip yesterday, and Hang Seng Tech is still down early, not to the extent yesterday. We might get dip buyers coming in, of course, following the declines we've seen of late. We'll get you a full preview of the trading day ahead, including some of the individual names for tracking in the Wednesday session. Plenty more ahead. This is The China Show. Right, welcome back. Hang Seng Index, Hang Seng Tech. We talked about how we are getting close to this number one support level to watch, which actually held quite substantially the last three sell-offs. That's the one level to watch. Below that, I don't think we'll need to talk about that today, but just to get it out of the way, of course, it's just below 53.50, which would take the index into a bear market. We're still some distance from that point in time, though.
Yeah, in terms of stocks to watch here today, obviously the tech space is very much in focus, given already you're seeing that downdrift here. Sunart Retail, we're hearing that they're unable to contact the CEO. Not much change into the stock here this morning. But let's focus more on the HSTECH moves that we've been seeing, right? Because it was largely like the EV space that's been dragging things down. When you talk about, these new regulations around hidden door handles now, you talk about the slow sort of what we're seeing in the domestic business there and the slowdown in EV sales. But there you go. You are seeing now some of the, tech plays as well, like Alibaba, Tencent, Baidu are all more than 1% to the downside here. This whole concern of VATs, you get a lot of commentary now from the likes of Morgan Stanley's Robin Jing saying, look, it looks like these concerns are overdone. This might not be the right timing to be doing a tax on this right now when the domestic economy is still, relatively speaking, looking weaker. So what this means, obviously, is maybe it's just the telco side of things where people say it's more of a targeted sort of tax versus the rest of the tech space. That's what we're at least seeing right now. But certainly Xinhua also came out and said, don't be too concerned about, or these rumors these rumors are false, at least for now. Here are some of the metal plays here this morning. Jiangxi Copper, CMOC groups. The copper plays are still doing very well. Gold is also following there with the Zijing Mining. We're up 2% there. And silver also still doing also recovery when it comes to the miners here today. Oil stocks as well, following the price of crude higher here. You're seeing Shanghai crude really following what we've been seeing with Brent and WTI. We're up 3% for futures there. And there is a trading debut here today, Qingdao Gongtech. This is a plastics company. Yeah. There you go. 25% upside there. And we got a breaking news, too.
We do. So you have GIC and Temasek, based on our sources, we understand that they're revamping how they deal with hedge funds. Full story is on your Bloomberg terminal, right? You can check that out. We'll be back for the open. This is The China Show. Welcome back. You're watching The China Show. 40 seconds to the opening bell. We're going to get some data coming through in about 15 odd minutes from now, the rating dog PMIs. We also did get some of the PMIs across the region. Japan, Hong Kong should have been out. We'll talk more about that. In terms of the market action, it's not so much here, but in other markets like Japan, for example, where we are feeling some pressure in the tech space given the software sell-off overnight. Although things did already sell off here in Hong Kong yesterday. Yeah, I mean, on this whole concerns about VAT, and really we're trying to get a bit more clarity on that. Yeah. So the telco side certainly was the how it all started, right? This VAT rate tax hike, I should say. But then it kind of rumors spread that this was going to go to the gaming sector, then the whole tech sector here. You had at the market close, Xinhua News dismissing those rumors of more VAT hikes, and they're talking, to identify experts, industry insiders, and the like. But there was speculation that it could be, taxes are going up to 32% from 6%. So that did shock the market in some ways. But we'll see, right? Citi is saying that this substantial VAT increase are overdone for now. But we're still trying to get a bit more details on that front. Onshore markets are doing this right now. We're down about a third of 1% here. We're still tracking what goes on in the commodities complex here. Copper seems to be catching a massive bid here. We're up 3% in the futures there. Shanghai crude as well. The iron ore, steel, not really taking part. You take a look at how the HSTECH things go. We are down another day. We'll see if we get to that final kind of,
bear market sort of territory here. We were on the brink of that yesterday on the news of this VAT tax.
We took one level out.
But yes, now you take a look at Baidu, Alibaba, Tencent, Xiaomi, Meituan, all lower this morning. It's not just the VAT tax concerns, it's also the EV concerns, given the regulations around how they have to change door handles now. Domestic sales have been weak. So certainly there's a lot weighing on the tech sector in HSTECH. We talked about already the competition with Korea, the Samsung, the SK Hynix is there, and the combined market cap is already overseeding some of the bigger names among the China space, right? So that continues for another day. HSTECH down 1.5% or so, and that brings Hang Seng now sub 27,000. Let's flip the boards and see what's going on with precious metals, copper and the like. And it seems like we're still seeing a decent recovery underway here. Or some of these miners, Jiangxi Copper, CMOC Group are all up about 3% or more. Certainly there was talk about the silver fund and how they're changing some of the metrics there on the fund, which could exacerbate actually some of the losses from the retail side of things. So that certainly is still a key concern, is whether we do see that sort of dip buying from Chinese investors and traders leading up to that Lunar New Year holiday as well. Oil stocks are doing this here, should be following the oil price higher here this morning. And there you go. China Oilfield Services, for example, leading the charge. We're up close to 3%.
Okay, I'm going to ask our team in the gallery to please bring up the Hang Seng Tech chart, because as our markets producer had pointed out just now, at the open, Hang Seng Tech just made an immediate play for yesterday's lows. So we are now below that 5,400 level. So the orange line is a support level. It looks like we were below that. The green line takes us into a bear market. So I mentioned a few minutes back, could be some way away. Well, we're closer now than we were a few minutes ago. And some of the drags, as we were pointing out, like Xiaomi and EVs and this whole cornucopia of reasons that markets seem to be cautious around the EV space, from door handles to pricing to competition, will be coming up on your screens very shortly. But yes, we're here from October 2 lows on the back of tech and EVs and all the sort of big cohorts within the Hang Seng Tech Index. Joining us now to talk us through the big declines and what's been driving this rotation out of these big names you see on your screens, Winnie Su, our Asia equities reporter, to tell us about the drivers of this rotation. Winnie.
Yeah, you just mentioned how this rotation is really happening, especially when HSTECH has been so weak. And yes, potentially today it may actually end in the bear territory. But when you take a step back and look at how it has trended, HSTECH down some 8% or so in the past 3 months, versus HSI is actually up about 3%. So that is really widening. And on two sides of things, we are hearing different factors. You just mentioned on the HSTECH front, there is that global tech rally unwinding domestically with EV and e-commerce platforms under some pressure. But on the other hand, we have HSI doing pretty well, especially when it comes to property stocks and financial stocks, because property stocks, financial stocks, they were both subsectors, both up about 10% in the past 3 months. And that's being driven by a brighter outlook for the housing market, the IPO market expectation, and also investors chasing for these high dividend yield stocks when there's so much geopolitical tensions going on.
Yeah, and that's what we've been waiting for, some sort of rotation for this rally to broaden beyond tech. So it could be a good thing. What is then the outlook when it comes to tech, for example? Is there still value to kind of stay in tech right now?
Yeah, so right now it seems like there is also a lot of divergence going on within the tech sector. Right. On one hand, you have AI still being very strong, and that's what we're seeing that's really playing out in Asia today, in fact, because South Korea, for example, even after that very big rally yesterday, still doing quite well today, even when we saw that big sell-off overnight in the U.S., while software stocks are under a bit more pressure, and that's why we're seeing a bit more pressure on HSTECH today, just because it does have a bit more exposure for software companies compared to some of the other Asia countries. But when it comes to a bit of a near term, you look at, for example, earnings perspective, earnings prospect, we have a 15% cut when it comes to HSTECH in just the past 6 months, while HSI about flat. And then on the PE side of things, valuation still looks more expensive for HSTECH versus HSI. So for now, seems like the divergence is likely to stay.
Well, what could reverse the trend?
Yeah, so a couple catalysts that we're watching at this point. If it's going to drop through the bear territory, actually it does provide quite a nice environment if people want to buy in for some of the dips, because it's going to look cheaper at this point. However, some of the other catalysts, for example, we're expecting DeepSeek's new model potentially coming out in just the next few weeks, maybe around Chinese New Year. That's what we've been hearing, so that might change the picture. And then adding to that, you've also have potentially further IPOs, and also that 5-year plan that is expected to be a lot focused on the tax efficiency. So those can potentially be that factor to drive tech stocks back into the play.
Okay, a lot of that in focus, this rotation out of Chinese tech. Arguably, some of that's gone into these Korea plays, some of that's gone into metals, some of that got burned, of course, in metals. It's come back out, it's coming back in. Winnie Xu there, of course, our Asia equities reporter. Just on the silver note, right, we were just talking to Thomas Zhao of Fidelity a few minutes back on his take on what's been going on in the silver market and what he sees as far as their flows are concerned. Have a listen to what he had to say.
Silver obviously has some industrial usage, but for the most part, silver is gold on steroids, right? So I think what we're seeing in the silver space is again more on the retail type of investment, and what's been really driving gold up until the last 20% or the last couple of months has been the sovereign institutions buying gold as kind of a diversification away from just U.S. dollar reserves, and that's not the case with silver. So you don't have that institutional sovereign backing behind it.
Yeah, as he said, right, institutional investors are staying out of all this here right now and sitting this one out here. It's all kind of what we're seeing is speculative and retail driven, according to Tommy Ta. And brings us a lot of questions. And let's bring in Matty Zhao, head of APAC Basic Materials, Oil and Gas Research of BofA Global Research. I'm sure you've had a pretty busy week, Matty. Just given the volatility that we've seen across precious metals, is this more than just a blip to you, or what's to come?
Yeah, so I would say that for 2026, gold is still one of our most preferred subsectors, together with aluminum and copper. But for Bank of America, our current gold assumption is 4,500 for the average of the prices. So we are positive, but because 4,500 is basically implying a 32% year-on-year growth already. Yeah, it's just that year to date it has been like so strong. I think some of the factors are actually better than what we thought. Like, for example, the geopolitical tension has been stricter than what we thought, and also buying from retail investors, from ETF, and also from some of the government reserves has been also very strong as well. And U.S. dollars has been weaker than what we thought. So that's why you saw the rally up until 5,500 and plus for gold prices last week, and big volatility. Going forward, we are still positive on gold because some of these supports hasn't gone away. Last night, we just published a new note saying that there's a possibility of gold reach 6,000 within the year as well, given that we haven't seen the stop of all these funds coming into the gold market. But we also warn investors to say that this volatility will become a lot bigger in the coming months, especially given what's the Fed's situations and also what's this investors' feedbacks in terms of all this gold rally.
What's the outlook for the actual miners that you cover? Because these are names that have re-emerged. They provided alpha. They're sitting on a lot of money. They're doing some deals across the world. What's your sense of the outlook?
Yeah, so for the industrial metals, like, for example, for copper, for aluminum, we are very positive. So for aluminum, for example, it is because of the no new supplies. We are seeing lacking of power in Indonesia, delay the supply from Indonesia, and China is already reaching this 45 million ton cap, and we see very unlikely for the cap to be lifted in the near term, because this is deemed as one of the role model for anti-involution. They're doing very successfully, and then also aluminum's margin has reaching historical high. It's actually 50% higher than last year already, even though last year have been doing very well. So that's on aluminum. And for copper, I would say that each country is fighting for reserve for copper, like China, U.S. U.S. traders been moving a lot of copper into U.S. If you look at the U.S. Exchange, currently the copper inventory is about 6 times higher than same time last year. So I would say that strategic reserve for the big countries is one of the key drivers. And of course, underground, the grid has been very strong. China just announced a 5-year plan for grid investment, which is up 40% over the last 5 years. And then grid is 40% of the copper demands. And of course, a lot of accidents globally and the great depletion, all these are adding the positive to both copper.
How much dip buying are you seeing among maybe whether it's retail, whether it's fabricators, whether it's manufacturers? I mean, how much dip buying is going on now given the route that we saw since last week?
Yeah, I think a lot of the retail buying in gold we have seen very obviously, like the ETF continue to grow. Like, for example, December ETF was up more than 80% on a month-on-month basis compared to the previous months. And you see probably people lining up in IFC over the weekend buying gold, right? So because of the dip on Friday. So I think that investors, retail investors' appetite is very strong. And then this also together come with the central bank's appetite. If you look at the central bank reserve of gold, it's already 18% of total reserve compared to 3% 10 years ago. So central bank, retail bank, and then the potential weakness on US dollar all adding the gold rally.
Okay. Which is interesting. So my brain just went to IFC because the line last year was Pop Mart. Now they basically turned the corner and looked at some of the jewelry
it's always been Laopu Gold too, right?
Oh, that's true.
Right?
That's true. Yes. Laopu Gold did have a massive line there. You took some clients on a field trip.
Yes.
It makes it sound like you're on a bus with free snacks.
A school trip.
But it was into the hearts of some of these mines in China. What did you guys find out? You talked to a lot of executives.
Yes. So I would say that China major players are still trying to add productions. For example, Zhao Mining, one of the biggest miners, they're adding 12% copper production and 17% gold production. So they're very active, also doing M&A as well, looking for more assets. But I think the biggest find out is investors are pretty worried whether these price hikes will cause consumption strikes. But so far we haven't seen. It seems that the consumer are still taking all this price hike. Like, for example, the grid, they're still buying the copper. For example, the home appliance, etc. Although we're starting to hear home appliance talking about maybe we want to switch into aluminum because of copper has been rallied too much. But so far, the consumption strike hasn't been seen, which means it's squeezing the midstream margins. Because midstreams, like, for example, auto, for example, home appliance, they are having pretty difficult times in terms of demand, right? So the midstream, i.e. the equipment providing to them, it's very difficult to hike prices or pass on the copper price to silver prices, etc. So basically, for now, it is squeezing their margin. But we haven't heard any production cut from this midstream.
And the biggest winners so far that are emerging are the upstream players now, the miners, right?
Yes.
Okay. What about solar? Is one of the areas you're cautious.
Yes.
Is that because of the pass-through on cost, or is that something else?
I think solar is more because of the demand that we are expecting the panel installation to go down by 25% this year. So at one end, you have weak demand from solar, and on the other side, you have high commodity prices like silver and copper. These are all major costs for solars.
Okay.
I was going to ask you about silver. If gold rebounds, do you think silver can follow?
I think it has already followed like yesterday, right? But silver, I think now it's not only, I think in our view, we prefer gold at this moment. We think that gold is still very supported from all the factors I just mentioned. But for silver, last night our note just pointed out that we think that silver, just on fundamental support, is more on $70 rather than like now it's nearly 90. Yeah.
From a regulatory perspective, and I think we have to separate the two stories. So there's an industrial component here, which you were covering. There's a retail component, which I imagine when you see prices go vertically, regulators look at that and somewhat become concerned over risks, leverage, speculation. How are you looking at the risk of, from a regulatory perspective, that they tighten some restrictions around retail retail buying in this
Yeah.
space, just to prevent prices from just going too far from fundamentals.
I think so far, like I take copper as an example, right? So even though copper has hiked so much, if you look at the key buyers like the grids, copper is probably 10% of their cost, right? So if copper go up by 30%, it's probably just 3% for the grid. So for grid, given they have large investment plan, I think they're not going to stop buying. The matter is for some of this consumption, like for example, home appliance is also a user of copper. So for them, they have to think of other ways. Like for example, like Matty, some of these key home appliance provider are thinking of maybe I use aluminum to replace copper. So they're already starting to talk about that because the copper aluminum ratio is over 4.2, which is historical high, which means copper is 4.2 times more expensive than aluminum. And normally it's 3 to 4. So now we are starting to hear some switch among the downstream, but we haven't heard about regulator talking about tightening the prices. Actually, on the contrary, we actually saw last week government come out to say that we should allow some of these prices hike, and it's pretty good for the CPI, and CPI negative is also a concern for the government.
That's a good point.
Matty, it's great to have you. As always, Matty Zhao there, head of APAC Basic Materials, Oil and Gas Research of BofA Global Research. But yes, buy aluminum, gold, copper, and lithium. Sell steel and solar. We just got some data coming through from China here. This is, of course, the private rating dog PMI numbers here. So what we've got from non-PM manufacturing, right? So services is 52.3. That is beating expectations and an improvement from the previous month here. The composite number was also better than the previous month. So better looking numbers here. Above expansion, of course, is what we got from the private gauge and the PMI numbers as well for manufacturing just a few days ago, and better than the official data too, Dave.
Now, separate from that, we're also getting headlines coming through out of China's vice finance minister speaking at an APEC meeting, talking about how they're looking to build this unified market to unleash domestic competition. They do face persistent headwinds and policy uncertainty. So far, those are what's come out of that. We'll get you more details once we do have them drop on our Bloomberg terminals. That said, we'll take a short break, and we will see you in a bit. Right, welcome back. So, yeah, in case you missed the big headline overnight, I mean, it took us some time to get here, but yeah, that's 75,000 now in Bitcoin. It wasn't too long ago, a few days back, in fact, we were talking about a break of 80 and what that might lead to as far as new downside. But yeah, lowest now since the U.S. elections, late 2024.
And it really has been interesting, right? This was supposed to be a pro-crypto White House. There's so much optimism around institutional adoption of Bitcoin and the like. And, right now we've kind of fallen to kind of to days before that, right? And really, when you take a look at this whole debasement trade, it was supposed to be, you sell the dollar, you buy precious metals, you buy gold, and you buy Bitcoin. But Bitcoin has not taken part in this debasement trade at all, really. And you've seen those two quite divorced for the past year or so. And we spoke to Galaxy Digital CEO Mike Novogratz about this, right? And he believes the crypto market may be nearing a bottom. Speaking exclusively to Bloomberg, Novogratz also told us what he thinks could turn sentiment around.
It's immature. We had a huge run up from where people bought it at 50, 100, 1,000, 2,000, 10,000, all the way to 100, 130,000. And I think what ended up happening was people finally started taking profits. After we crossed 100, it felt like the community had won. And it was that sigh of relief, like we did it. We created this amazing ecosystem, this amazing asset. And there's been kind of like a seller's virus that got into the market. People blamed it on quantum. I don't think quantum in the long run is really the reason. I think there was selling, and that selling is getting, executed in the market. There was buying, sure, lots of new institutions are coming in, but prices are set on the margin and there have been more sellers than buyers. I think we're getting close to the bottom, but we'll see. You always know a bottom after you see it. And listen, there's a couple things that could help, right? Market structure bill passing would be a big deal. people are really pessimistic on it right now.
Okay.
I actually am a little more optimistic that things get done because I think both sides want it done, but we'll see.
So what is the catalyst that turns the tide right now? You mentioned a market structure bill. Maybe that will bring some optimism, but I don't know. Is there anything else that could turn around this trade?
Yeah, listen, part of this acceleration recently downwards is the thought that Kevin Warsh is going to be very hawkish. Listen, what I think Kevin did is he took out the tail risks for inflation, right? He's a man of integrity. He has worked alongside Stan Druckenmiller for a long time, literally since he left the Fed. And so you don't think he's going to do whatever Trump wants him to do. That said, he's pretty dovish right now. And I think once he gets in and starts talking, looking at the environment that we see today, he wants rates lower. And I think once that market kind of rewrites him as a dove, at least a dove, given the current environment, that also could help.
Right. If you're one of our Bloomberg subscribers, you can rewatch that interview that we just did via the TV Go function. Also become part of the conversation. TV Go has that little button that you can press, and it takes us into a chat room. Reach out to us if you have any comments, suggestions, or questions you might want to ask many of our guests that are coming through in the next few hours or so. Yeah, software soft. That was the headline going into today. So tech is taking it, as you can see here on Hang Seng Tech Index. So we've now taken out support. We're about 40 points north of bear market levels. The Star 50 and the China Index are also seeing some pressure right now. More in the tech sell-off across the region. Coming up, this is the China Show.
Welcome back to the China Show. Here's a look at the HSI, half hour to the session. And yeah, we're looking a little bit better, but we're flat. I mean, we've recovered some of the losses at the get-go. But, right now, sentiment, we're still kind of figuring out what goes on in the HSTECH story here as we were on the brink of some sort of bear market yesterday here. There is still some concerns about the whole, rumors of VAT hikes as well when it comes to not just the telco side, but is it coming to the gaming sector? Xinhua really trying to dismiss some of these rumors out there here today, but still a lot of uncertainty on the AI trade given the Anthropic news as well, because software certainly is where things are getting hit because, with these new AI tools, what does it mean for some of these industries like data sort of companies, right? So the disruptors being hit.
Existential questions now. It's not simply a rotation of, we needed more of that, now we need more of this. This might sort of be a new model to talk about. Which is also just to say, right, so when we talk about the Hong Kong markets, later on in the show, we have a guest coming on. And among the very, very, very few analysts on the street that are not quite as bullish as the rest of the street on Samsung.
Yeah.
So that's going to be an interesting conversation. And what is the market missing as far as risks to that story is concerned? Speaking of an emerging AI play is where I went with that. Kospi index 1%, speaking of, right? There we go. Taiwan is shaking up the early cobwebs and the NASDAQ is now flat. Asia is now flat. Okay, so it's looking like we are turning the dial here as far as early losses were concerned. Nikkei was down over 1% about an hour back. So it's clawing back. Let's call it half of losses there. Software stocks across the region coming up on your screens. Are we seeing an extension of the losses from overnight? Yes, we are, quite clearly. So this still is the weak and pain point across these markets. The rest of the region, the rest of the sectors and factors are doing somewhat better than the software plays here.
Yeah, so that certainly is one thing, right? As you mentioned, it's more of an existential sort of question about what this means for some of these industries, which AI is disturbing and disrupting and potentially annihilating. So certainly that is one to watch. You saw that with the London Metal. What was it? Some of the stocks that really reacted to it. Thomson Reuters, all that, like here overnight. Yeah. So there's that. And then there is kind of this rotation of tech that we're seeing in Hong Kong as well, right? Whether it is a valuation story, whether it's the earnings prospects as well, there is this broadening out to things like property, to things like financials that are doing quite well. You could say it's a good thing that things are broadening out, but there's still a lot of questions about, the tech space. Is there still value in it? when you're still waiting for some sort of DeepSeek new model. You're still waiting for earnings to play out and the AI, the self-sufficiency and all that kind of thing. But this VAT tax has been there's a lot of debate about it. Is it overdone, these concerns?
Yeah, and I think you hit the nail on the head with the Xinhua report yesterday, right? And they're saying, that don't get, paraphrasing, 假的, right? That's fake, right? When it comes to that specific one.
The tax hike on gaming, I think they dismissed that.
Yeah.
There were concerns that it could go up as much as 30-some%.
Yeah,
so that's been dismissed. But really, there's going to be wider discussions about whether, why would the government be even considering this here right now? Robin Shing from Morgan Stanley had a pretty interesting note about it this morning, saying, this is not the right timing at a time when the domestic economy is still looking seemingly weak, right? If you actually hike taxes across the tech sector, more broadly speaking, that's going to dampen consumption further. That's going to dampen investment. And in some ways, it could reinforce this whole disinflation trend once again.
Right. I mean, some clarity in the policy messaging might be somewhat necessary, given speculation on that front, right? Because you are getting an extension of some of the subsidies into some of the services, but then you pile on a VAT. Obviously, what those rates will be dependent. Are we just not better off net, right, when you think about it that way? But yes, I mean, lots of clarity will perhaps be necessary as we go into, I think, number one, Chinese New Year in a couple of weeks, and then a few weeks after that, we go into the two sessions where you get this whole flurry of targets, growth targets. Following, I think last week you had a lot of provinces looking at their specific targets for the year and what that means. Is it about 5% or is it 4.5% to 5%? Right? I think I digress. The other big story, of course, which is Indonesia, that's coming online right now, 0.4%. I'm looking at my boards. Amidst what has been anything but a normal past few days for Indonesia, somewhat back to normalcy on price levels right now. And this is really on the back of conversations around MSCI. In fact, just today is up, but over 5 days, it's just been this is about, a 1,300 point swing on the index itself.
Yeah, certainly it has been a massive sort of swing, as you say, right? And the finance minister clarifying that he's not concerned for now about the possibility of an MSCI downgrade to frontier market status. Speaking to Has at a business forum in Jakarta, Prabaya Yudi Sadewa also told us why he thinks the index provider's warning is actually a good thing.
As I told you, the intransparency in the market was quite big. I've told myself to the stock market management at that several months ago to clarify the market from this cooking practice of manipulating prices of shares, but they didn't do anything. So to me, MSCI warning is a good thing because I can write them to clear the market practice toward the better.
Are you concerned about a possible downgrade?
No, because it's improving the condition. Unless we ignore the MSCI warning until May, then we have to be concerned. But I think the government and every market regulators have taken a proper approach to ensure that before May this year, we will satisfy what the MSCI wanted. So you should be okay. You should be fine. Investing in my country should be okay. We will adhere to the global best practices.
You're expressing confidence, but there is a real risk of being downgraded by the MSCI. Are you prepared for that? What measures are in place that could possibly mitigate the impact of a downgrade?
No, we will satisfy all of the MSCI's, all of things that MSCI wanted, including basic transparency. For me, as a Minister of Finance, I'm not involving too much with what's happening in the boards, but I focus to ensure that the economy moving in the right direction. We make sure that our government spend enough money in the first quarter, second quarter in a timely manner, and we ensure also that there's enough liquidity in the market, and we are making sure that we are improving our business climate. We have this special task force of the bottlenecking, where every businessman can report to us, and on a weekly basis we have a meeting, a proceeding to ensure that the bottleneck that they are facing is removed properly. I think 1 year from now, we will have a different and much better business climate condition. That's enough to create a better and faster economic growth. Eventually, it will be represented on the increase on prices of shares in our capital market.
We recently saw the seizure of the Matty gold mine, and some say that perhaps a reflection of the lack of due process in Indonesia.
Due process?
Due process.
Due process. Something like that has been occurring in our country over the last maybe 20 years or 30 years. We are removing that bad practice in the mining industry. One of the samples is that the abolishment of the permit of the company. This is one step to make sure that we are conducting a good investment climate, a good practice in mining activities in the country. It's not like we are against mining, but we are against illegal mining.
There's a lot of speculation, and there's even suggestion from the likes of Citibank.
Economist from Citibank?
Yes.
He's not a real economist, he's only a master. You should ask a PhD to answer that question.
Suggesting that perhaps you will move your cap beyond 3%. Is there a chance of that happening?
I'm the minister, not him. I understand fiscal policy very, very, very well. I learned from the best from everybody in the world about fiscal policy. The reason why last year we pushed the deficit towards the boundary of 3%, because the economy has been slowing since the beginning of the year, maybe since 2024. Deliberately slowed down by our policymaker at that time, and the economy is moving downward. We have, if you learn economy properly, in a downturn, the government should create a counter-cyclical policy to ensure that the downturn is not becoming a recession. We did that. We we expanded our fiscal. We give stimulus to the economy to make sure that the economy is returning like that, and it happened. In September, we managed to turn around the economic direction. September, October, November, until now. So we pushed the deficit towards the boundary, but at the same time, we managed to limit the deficit not surpass the 3% level. This is fun. We're successful in creating a turnaround, but at the same time, we managed the 3% level. That's a work of an expert. In the future, I don't want to surpass the 3% level, because people like you, media, will crucify me and tell everybody that I don't know my job.
Oof, what an interview. The Indonesian Finance Minister Per Yudi Sadewa that I was speaking with has in Jakarta. Still ahead, we turn our focus to, of course, the chip makers in Korea, and while the likes of Samsung and SK Hynix have been on a tear, we're going to hear from, maybe a non-consensus call, Morningstar. Still staying cautious here when it comes to some of these chip makers in Seoul.
But ahead of that, one of the world's largest asset managers will get a glimpse of the APAC business with Franklin Templeton. Tariq Ahmad joins us in a couple of minutes to talk us through their expansion plans, private markets, alternatives, digital assets, as well as their strategy in China. More ahead. This is The China Show. Right, welcome back. You know that feeling, you're just easing yourself into Monday and you need Friday. So we're, 4 days into calendar Feb, and I need the year to just turn us into 2020. See, I forgot the 2027.
It's also that just awkward time between Christmas and Chinese New Year that we feel here, right? You're just kind of in this lull, but then there's just so much to talk about across markets as well.
Not as far as time.
Time.
Right? Yeah, but
not in terms of news flow, though.
No, we're dizzy. and we need a break. Let's get the views right now across assets, given this volatile start to 2026. The regional head of one of the world's largest asset managers joining us exclusively here on set, head of Asia Pacific at Franklin Templeton, Tariq Ahmad. Very nice to see you, sir.
Good to see you again, David, Yvonne. Thank you for having me.
Must have been a exciting last few weeks, but we'll talk about current flows in a moment. But last year, how was last year for you guys?
Last year was very, very strong, I would say. I mean, globally, Franklin Templeton, we had a record year in terms of flows coming across channels of institutional and wealth markets. Asia Pacific in particular was very strong on the wealth aspect. Alternatives, strong growth area for the firm. That's a deliberate bet we're putting in across the organization. That grew significantly. And then I would say, like on public markets, when you think about the growth we're seeing on more diversified solutions, multi-asset income is a key theme across the region. That's doing really well for us, and it's growing at a very fast pace.
In terms of flows, where are you seeing the biggest demand right now in markets?
So I would say, Yvonne, it's two areas really. I would say one is there is a bit of a broadening theme at play. So when you look at the macro backdrop today, there is some asset movement away from the US at a margin. And in Asia Pacific, clients are looking towards European assets to some degree.
Interesting.
So that's kind of happening. Gold and precious has done really well.
Yeah.
Right? So that's been a beneficiary against the overall backdrop.
Right.
Private markets, I would say, through innovation of new structures coming to market where you can provide more solutions which are a bit more open-ended, perpetual. And that's providing access to wealth clients to really kind of benefit, to get exposure into this new asset class across secondary private equity, private debt, real estate, all growing, at a good rate.
Talk to us about gold, because you have conversations with arguably the biggest buyers that matter, central banks, right? So what's your sense of demand for precious metals among the largest of the largest institutions?
Very good question, David. I would say, look, when you look at the central banks of the world who have been at the margin increasing some of their exposure to gold, but the recent IMF study has shown us actually it's been net zero in terms of allocations increasing. What's increasing has been the market movements because the gold prices have accelerated and that's increased the reserve to some degree.
But the value of the reserves?
Absolutely.
Okay.
But some central banks have been increasing their exposure in this part of the world, and that's happening.
Yeah, would you say that a lot of it, what we're seeing, the volatility is mostly retail driven? And it seems like we're back to levels that we saw only in mid-January, right? Is that still sort of bull run in precious metals? Is that story still intact, you think?
There is some slowdown. So I think towards the start of the year we saw increased buying, into some of our mutual funds. So we saw some renewed interest from the wealth clients, some more retail buying that took place, and that was more of a hedge. Uncertainty, unknowns. Just looking at the overall factors coming into the start of the year, that somewhat waned off a bit. Clients are back into riskier assets in terms of looking at more diversified solutions. Income, as I mentioned, is doing reasonably well, and even thematics. Technology solutions, etc. In terms of getting exposure to those themes are still at play. And by the way, also what's kind of getting really interesting as well is as you kind of break out the themes away from the globe in terms of looking at the US market, the European markets, in Asia Pacific as well, you're seeing very interesting kind of aspects of the India story, right? Yeah. China is back. China is looking really, really, I would say, attractive across a number of sectors, AI, robotics, EV. So you're seeing a lot of interest coming into that market. Japan, I would say, given governance changes, given improvement in some of the companies, initiatives by the local government as well. You're seeing a lot of interest coming into Japanese equities as well. And by the way, Australia, which is a very interesting market. Australia has been a very resilient economy, right? Since the pandemic has done reasonably well as an economy, has been growing, has been doing pretty well. And actually, if you're looking to diversify, get exposure to interesting areas, avenues of new sectors, I would say in Australia looking quite attractive as well.
Yeah, in fact, they were debating, they hiked interest rates. They're doing that well, arguably, if you think about it. Japan has, I think we last spoke 2 years ago, Japan was emerging. It continued to emerge. It's blossomed into just many types of solutions now. So from your business perspective, what are the priorities in the Japan business? What's popular there now?
As a business, I would say, David, the wealth segment is very attractive. So if as an asset manager coming into Japan and you look at some of the initiatives coming in, like NISA, which you spoke about last year or 2 years ago, NISA is still growing at a very fast pace. So, there's a lot of, I would say, focus to position solutions there to attract capital. Keeping in mind, as Japan is coming up to a level where rates are increasing, right? You're seeing real rates increase.
Right.
In the old days, sitting at cash made sense because if you're sitting at cash, you're still earning because negative real yields, your real yield is actually positive in terms of your rate of return. And now investors are sort of being pushed out to think about, okay, well, away from cash, where do we start to invest? And they're sort of really kind of increasing their risk spectrum in terms of going into riskier assets. When it's a riskier, I mean, they're going into more of the active part of the world to some degree as well. So that's happening.
In terms of private markets, I mean, obviously there's been a lot of a push for that. What are sort of the alternative strategies that are still quite popular?
So for us, I would say two things really kind of stand out in terms of opportunities at these levels. Commercial real estate debt on the private side is very attractive. We think it's quite unique, provides interesting income components as an asset class. And the second area for us would be secondary private equity. We think that's going to be a growing asset class again this year. For us, it's been, I would say, a very successful investment looking at secondaries, and I would say that theme will continue. And this year, we also have had a continued kind of demand and interest for the wealth clients to kind of get access to perpetual solutions on the secondary piece side of the business.
Okay. Just one last question before we talk about China. On commercial real estate debt, that's interesting. I'm just curious, what kind of yields are available right now to folks?
So you can pick up 5 to 6% or even 7% in terms of yield.
Is that investment grade almost, you think?
Almost investment grade.
Okay.
And that's a very good question you're coming into here because the question comes in is to say, well, on public markets, if I can get headline 7% yield on a security, why would I go into a private debt solution?
And give up liquidity.
And the answer there is going to be, if you're managing a portfolio, which is going to be a bit more diversified. As an investor, we say, look, being diversified matters. Staying invested for the long term is equally important.
Right.
And also having access to sources of capital and returns is going to matter as well. And real estate debt offers you a diversified and an alternative source of capital or return that sits well with the overall portfolio allocation.
You mentioned earlier that China's back. How are you capturing this recovery in China? You do have a JV there. What's the future of that partnership?
So we have a joint venture, Yvonne, that's been there for a very long time. It's been very successful as an investment, as a business, and with a very, I would say, talented investment team as well. So that continues to grow with us. We are equally invested. I mean, I think it's going quite well. Conversations are happening in terms of what we can think about the next step of the JV. But we're also exploring other avenues as well, because China now, when you think of the wealth segment, again, is growing at a very fast pace. You're seeing significant level of capital that is sort of sitting in China that needs to be sort of managed with new tools, new solutions. And we're kind of exploring ideas to see how we can kind of engage to provide that access to investors. You look at ETF Connect, for instance, what's happening in Hong Kong, for instance, almost $200 billion turnover is happening. So there's a lot of activity, I would say, in terms of solutions you can kind of capture, in a China market.
And is that something as a strategy you want to capture out of Hong Kong, or do you want to do that on your own on the mainland, away from the JV? How are you thinking about addressing that demand?
I would say, David, as a business, having perhaps both aspects positioned will really matter. When you think about sort of sitting in Hong Kong as a business where we've been very successful, we are pretty much sort of tapping on to making sure that all the avenues are available for us. Mutual fund recognition program, GBA Connect, so we can kind of make sure we have good solutions waiting here. And then onshore as well to see, how do we kind of position the ideas there as well.
Tariq, it's great to have you. Tariq Ahmad there, head of Asia Pacific at Franklin Templeton. And if you are a subscriber and want to rewatch that interview, you can do so through our interactive TV function, TV Go. You can also become part of the conversation, send us instant messages, comments, what have you. Check it out at TV Go. This is Bloomberg. Some stories that we're tracking for you this morning. Prudential says it's suspending all new life insurance sales in Japan for 90 days. The move aims to restore trust after some former employees engaged in financial misconduct. Now, the suspension is set to begin next Monday as the firm implements operational and governance changes. It will also reimburse policyholders who were wronged. Nintendo shares fell to the lowest in over a year after weaker than expected earnings, highlighting pressure on profit margins. Rising memory prices are threatening margins for the Switch 2, even with long-term supply contracts in place. Nintendo left its full-year revenue and profit guidance unchanged and maintained its Switch 2 sales forecast at 19 million units. Shares down some 10%, Dave.
Yeah, not a good one. Not a good one. Okay, speaking of earnings out of Japan, Fuji Media also coming through. And, again, I think what we've noticed is the market's doing well on dips, but the reaction function seems to be more pronounced on the negative side if the stars don't align effectively as far as what's reported and what the guidance is coming through. Software stocks is going to be interesting too coming through. Following obviously the overnight session, the Anthropic news, and we're seeing this across Asia Pacific, and we are seeing it quite substantially. These are big names that are getting sold down quite a lot, 2.5% on Tencent. Kingsoft is 3.5% there. Battery and solar stocks coming up very, very shortly on your screens. We'll talk more about this later. Plenty more ahead. This is the China Show.
11:29 a.m. in Tokyo. Japanese markets heading to that lunch break in just a moment. And yeah, we are seeing when it comes to Nikkei 225, more downside there. We're down 0.6%. The Topix is doing a little bit better there. There is some weakness in the yen this morning. We're back to around 156 levels. But yes, the rest of the market seeing a little bit of retreat when it comes to Asia here this morning. And really the tech space is where you are seeing most of the pronounced moves to the downside here today, Dave.
Yes, absolutely. And the software space that's coming up very shortly on your screens. In fact, when you look at Asia Pacific, we're down 0.25%. U.S. assets are stable. There's not really a lot of interest at this point of the day, so that seems to be back to normalcy if you think about it, given the declines we saw overnight. And specifically, the Goldman basket on software stocks really took a hit there. So what else do we see here? So commercial services, bottom row, third tile. That's the Tencent drag that's showing up there. We'll talk about this VAT in a moment. And IT, that's more a hardware play, 1.25% there to the downside. We're still on bear market watch on the Hang Seng Tech gauge. We're not there, just to be clear. We could get there if we see further declines from here, but we are hanging critically just above this support level. Below that, we'll get it to bear market. But we can take a look at that later. But yes. No, why not? Right now.
And what could take us there and what really almost took us there yesterday were these concerns about a hike in the VAT. First it was in the telco space, but then rumors started spreading that it could be in the gaming space or even just the whole tech sector. But yes, Xinhua came through yesterday trying to dismiss some of these rumors out there. So certainly there's a lot to talk about here. Let's bring in Bloomberg Intelligence, Robert Lee. He's here to walk us through kind of what this means for some of these platforms that you track as well. First of all, what do you think is driving some of these changes around VAT?
Okay, there are probably three things. The first one is harmonization, because previously, back in the day before the internet and demand for data exploded, the bulk of telecoms companies' revenues were obviously voice call related. But these days, the mix has turned to data. So the government is looking to harmonise tax rates to increase the rate that it charges on data-related services, bringing them up from 6% to 9%. So that's the first thing. The second thing is, as in all governments globally, revenue raising is always a priority. Most major countries around the world are running fiscal deficits. China's is sort of in the middle of the range versus other comparable countries, I should say. But given the ongoing issues in the property market, taxation on land sales and property sales used to be a big revenue driver. Obviously, the government needs to rebalance its finances and look to other sources of revenue generation, so telecoms and perhaps internet companies being one of them. So that's the second thing. And then the third thing is maybe it ties in with the anti-evolution drive, because we've seen really cutthroat competition amongst the telco companies. So by increasing the tax it's charging on these basic data services, in theory, will discourage them from being so aggressive in terms of competition and encourage what they have or use their free cash flow more for investment purposes than trying to take each other out of business. So I think those are the three drivers. Whether this will translate to the internet sector remains to be seen.
Yeah, I was about to say, because there's a difference between rationalizing your revenue streams given realities, right? So we scroll more than we text.
Yeah.
So, the voice to the data thing. But it's different when you want to raise it on internet, for example, somewhat different. So is there a probability we can attach whether or not that's the next step that perhaps isn't even the same conversation? I don't know.
Yeah, as Yvonne mentioned in her intro, there was some speculation that maybe video games could be taxed next to maybe as high as 32%. I think Xinhua has been very clear on that. That's highly unlikely. Yep. But again, the internet companies have a large revenue base. They're obviously an integral part of the economy. They're essential part of daily life these days. So if the government was looking to increase taxation revenue, they would be an obvious place to look. Having said that, there's no immediate signs of that happening. But they have substantial revenue bases. And one of the trying to sort of refresh on my knowledge of tax. The question is whether software is taxed as a good or as a service. So the levels of taxation on goods is substantially higher than on services. So in theory, there is scope to reclassify software services in the future, or there would be, and maybe as a revenue-generating move from the government. But there is no sign of that whatsoever at the moment. And also, as we know, markets have been on a tear, particularly the tech sector. Markets were maybe looking for an excuse to sell and take profit, prompted by what we've seen in the US. So I think you have to look at the backdrop as well.
Earnings are coming up. A lot of these haven't reported yet. What are you looking out for?
It's going to be a mixed bag as usual. Tencent, I think, solid as she goes. Very diversified business, global leadership in most of its sectors. It almost never disappoints. Famous last words. So I think that is going to set the tone. Whereas companies like Alibaba and Baidu, the growth in their cloud services business, driven by AI, will obviously dominate headlines. But the reality is, it's depressing their free cash flow generation, and the level of income generation coming from that is very low. Just to quote a number on Alibaba, as you know, is going to invest over $50 billion in cloud services over the next 3 years approximately, whereas the underlying profit within that cloud business in US dollar terms is only about 500 million. So the level of margin is very low, reflecting the effective subsidization in support of the government's AI strategy. And as I said, it is having quite a detrimental impact on their free cash flow generation. Their balance sheet is still solid. We don't need to worry about the bonds or whatever, but the ROI and returns are not coming through.
Robert, thank you. Oh, you went through the capital structure there. Fantastic. Thank you so much. Robert Lee there, our Bloomberg Intelligence senior analyst. Let's stay on tech here. So coming up on your screens is what would be a shocking number if you weren't used to the new normal. So SK Hynix, for example, right? The stock was already up 275% in 2025. About a month in, we're already up 40%. On the stocks. I think the statistic we had yesterday was the market cap of these two are now bigger than the combined one of Tencent and Alibaba.
Yeah, the two bigger ones in China. So it goes to show where investor preferences are lying here. Are you betting more on the supply chain of global AI and tech versus the homegrown sort of tech sufficiency story in China, which looks a bit tired of late compared to what you're seeing in Korea here. But certainly there's been a lot of shocks as well. I mean, take a look at what happened with the sell-off in precious metals. I think Korea was one of the first to feel the brunt of it. So when it comes to what the street says, I think most people are still quite bullish with Samsung and SK Hynix, just given what we're seeing in memory chip prices, right?
Yeah.
But some out there are less than bullish, right? And in terms of what all the analysts that Bloomberg tracks, Morningstar has been one of the ones that I guess willing to stick their neck out a little bit more. Jing Yu, equity analyst at Morningstar, telling us to be a little more cautious when it comes to some of these Korea plays here. Jing, it's great to have you on the program. Yes, it's hard to be a contrarian here, but I want to tell us a bit more about your call around Samsung here. What do you think, for the most part, what are investors missing?
Right. Thanks for having me. So, well, with the recent earnings, the earnings has been really very strong, and we have raised our fair value estimates due to the stronger visibility and stability of the AI demand runway, at least over till 2027. Hyperscalers continue to post strong earnings despite, digesting the massive capex that they have incurred over the past 7 to 8 quarters. While AI demand, we see as becoming more diversified. Previously we were really skeptical of OpenAI's massive commitments. Number one, how they would fund it, and number two, how ironclad these commitments were. With Google and Microsoft, strong, demand for their chip, for Google's chips and Microsoft's upcoming Maya chips, we think these risks have been diversified overall and have raised our fair value estimates in response. That being said, I think where we differ from the market is that we believe buying into shares currently imply expectations of structurally higher memory prices 5 years and beyond. The demand runway today looks really solid, and with little fresh capacity coming in, we expect prices to stay high near term. However, we do expect massive capacity to come in from all three players in 2027 and beyond. And and in our view, this will balance out the strained demand supply dynamics we see today. To us, memory pricing is really a pure function of demand and supply, and we currently see this pricing upcycle as the imbalance of that. So this underpins our more measured and conservative approach towards these stocks, where we really see less than optimal risk to reward in the current upcycle and the current at the current point of the pricing cycle.
I wonder if you could put that to us in perhaps simpler terms. I like what you said there. The markets, for the current valuation to make sense, the price hikes need to go consistently into the next 5 years. So what price hikes this year would justify current? How much higher do prices have to go on memory to justify the current valuation?
Well, now that's really kind of that's really in the wind, in my opinion. I do think that it's less about how high prices can go today and how sticky prices can be in the long term. Because in Morningstar, we take a look at our stocks across a 5-year, and we take a cash flow approach. So imbuing cyclicality into our stocks naturally gives us a more conservative approach over the long run.
So you mentioned. So how long do you think we could be in this super cycle for memory? That you mentioned it could be years. Some are saying 2027. Yeah. What's your forecast?
Yep. So right now I'm looking at 2027. In 2026, we're not expecting tremendous capacity to come in. And in 2027, we're starting to see some capacity come in with most of the capacity ramping up in the second half of 2027 and 2028. We see, the supply demand dynamics being consistently strained until 2027. But we do see, this new capacity, fresh capacity that's coming up, which is rather material to be able to offset or balance out the dynamics that we see today.
Between the two stocks, Samsung and SK Hynix, do you have a preference one over the other? How close is the other one? Because these two seem to be the only names people are talking about as number one and the challenger that's getting close to the other one. Compare and contrast the two companies for us.
Right. So SK Hynix has been the leader in the HBM space. I think ever since HBM3E, it has established a clear lead over the peers. A lot of this leadership has been priced in, and the expectations here are tremendously high for SK Hynix to maintain its lead. From a risk to reward perspective, I do expect Samsung to be a better pick than SK Hynix, given the fact that it is a challenger in the space. There are still naysayers and skeptics of its ability to commercialize HBM4, despite having qualified for HBM3E. We actually think the qualification of HBM3E and the recent channel checks that we have done on HBM4 have given us more confidence in Samsung's ability to catch up. That being said, we do expect SK Hynix to still be a leader in HBM4, but the optional upside of Samsung being able to close that technological gap tremendously gives us more confidence and more optimism in the overall risk to reward profile for Samsung.
Okay. It's hard to kind of stand in front of this train. I'm going to ask you, what could change your mind? What do you still need to see in terms of maybe AI, for example, for you to really kind of change your mind, be a bit more optimistic around the stock?
Right. I think, one of the few factors that we will have to see would be that AI capex reaccelerates, right? And this is primarily coming from hyperscalers, from internet giants. We would also need to see plenty of this. I would say conditional commitments coming through, primarily from OpenAI, where we are still skeptical about in terms of the ability to fund these commitments. I think these factors would tremendously raise the overall demand for HBM beyond to what we think even 2027 or 2028 capacity could supply. So with that, should that occur, and we do expect the overall supply chain to remain constrained beyond the next 5 years.
Fantastic the way you frame that in terms of, CapEx will be the thing to watch, because if these things were easy to see, markets would have bought into this, right? And to your point, what really changed was markets re-rated because suddenly you had a wider adoption for memory. And I wonder, do you see the possibility that the adoption or the applications of memory go far beyond, not even far beyond, just incrementally beyond the current applications of the technology, which could be the next re-rating to come? I don't know.
Yeah, well, I think there are some new products that are coming in beyond just HBM and the conventional DRAM. These products are still relatively in the stages of in very nascent stages, with commercialization not expected to happen anytime within the year. That being said, I think how these use cases blend into the overall ecosystem of AI, of consumers, is still yet to be seen. We could see perhaps some cannibalization of a traditional HBM or traditional DRAM memory for the use in exchange for the use of these products. That being said, I think it's still really out in the wind as to how all these different kind of products would mingle and coexist in the ecosystem.
Jing, appreciate the time, and thanks for giving us a different perspective on all this as well. Jing, you there, equity analyst at Morningstar, joining us from Singapore here on their contrarian call when it comes to Samsung and SK Hynix. Coming out, China condemns a Panama court ruling against CK Hutchison port operations. They're calling the decision, quote, absurd, and warning of consequences. We have the details coming up next. This is Bloomberg. We're watching CK Hutchison this morning after a ruling by Panama's top court to avoid its contract to operate two ports. And China has responded and really denouncing this move as, quote, extremely absurd. Let's bring in our China correspondent, Min Lo, now on some pretty strong reaction from Beijing on this deal.
Yeah, so the Hong Kong and Macau Affairs Office had put out a statement on WeChat, and it's a very, very long statement. And I want to read you some of the quotes because it's pretty incendiary. And this is not the exact copy because it's in Chinese, so this is a Google translated version. It says, the ruling is legally absurd, logically flawed, and utterly ridiculous. And it says, the ruling succumbs to hegemony, obviously referring to the US, and it acts as an accomplice to evil. It is truly shameful and pathetic. And it ends with saying that the Panamanian authorities have to recognize the situation and correct their course. If they persist and remain obstinate, they will inevitably pay a heavy price in politics and economics. Exclamation mark. Mm-hmm. So it's a very, very strong statement from Beijing. And it does seem like, judging from the tone of that statement, that Beijing might be prepared to retaliate against Panama. Not clear what sort of actions, but it says that Beijing will not sit idly by in the face of bullying. It says Beijing has the means and capabilities to maintain a just international trade order. This comes after the Panama top court had ruled that CK Hutchison's right to operate the two ports in Panama Canal is unconstitutional, even though the company has been operating there for nearly 3 decades.
Okay, well, how does this materially affect the deal to sell that fleet of ports then?
Yeah, obviously it's going to complicate the situation, right? Because there's a lot of question mark now as to what Hutchison can do with the Panama ports. It doesn't really have a lot of options because it cannot appeal against the Supreme Court ruling, but the company has said it started an international arbitration process. So we'll see what happens, and obviously perhaps there might be impact on the valuation as well. And it's already faced a lot of challenges, right, in terms of approval from Beijing. The company had to bring in Costco, a Chinese state-owned company, to hopefully get Beijing to soften its stance. And the last we heard was that CK Hutchison was looking at a complicated deal where they would parcel out its fleet of ports so that Costco could have greater control over ports that are in friendlier nations such as the African nations, while BlackRock and other companies could have greater control of the other ports in less friendly nations. So the structure itself is already very complicated, and this is just yet another geopolitical challenge to that deal.
Right. Well, that's the latest. Clear and then complex. Min Min Lo, our China correspondent, on the statement, not Min Min's delivery of that, of course. Complex is the deal. Okay, let's get to some big corporate stories we're following out of China here. A state-backed industry group has urged China to boost strategic copper stockpiles. Now, the China Non-Ferrous Metals Industry Association called for larger reserves and closer coordination with state producers, copper jumping nearly 5%. In London, what are we doing now is the question. That's ahead, of course, of Lunar New Year.
Well, the Shanghai's Future Exchange is widening daily trading limits for silver futures from after today's close. Limit rises to 19% from 17%. Now, the exchange is also raising margin requirements, increasing them to 20% for hedging positions and 21% for non-hedging trades. And it seems like some of these moves certainly is helping at least the market stabilize in some ways here. Take a look at how silver futures are doing here. We're up about another 5% here. Gold as well. We're back to above that 5,000 level for futures are concerned. I think Bank of America just said their forecast is still around 6,000 for gold. So maybe there's still upside here for bullion. Copper also recovering quite well here right now.
Yeah, interesting there. Coming through out of Matty, Zhao, who joined us earlier on. So it could get to 6,000. The average for the year still about 4,500, which is still quite a substantial upgrade, of course, from the average of last year. That's the metal story. For now, it's a fluid story. Plenty more ahead. This is Bloomberg.
Time for a quick look at what's making headlines in Chinese media today. There has been some extensive coverage about the central government's first policy statement this year, focusing on agriculture and food security. Now, the document calls for strengthening China's agricultural capacity, upgrading rural infrastructure, and expanding domestic food production. Now, specific measures include ensuring stable production of grain, edible oil, also integrating AI and robotics into the ag sector.
Yeah, in fact, we're looking at ag tech stocks really on the back of some of the conversations here coming up on your screens. We are getting some moves to the upside. Zhejiang Top Cloud Agri Tech up about 4% on that specific stock. Battery and solar stocks also very much in focus today. And by the way, separately, there's a broader conversation on EVs that has been really on the weaker side, I think. But at least for today, this specific cohort is catching somewhat of a bid here. New grid backup policy. And I guess initiatives there to be able to to bolster that part of the process. It's also worth noting BofA, who joined us early on, is still cautious on the solar sector. Specifically, that's really on the back of their call on prices and installations.
Yep, and China Property is still kind of leading some of the gains that we're seeing when it comes to Hong Kong here today. So it's interesting, right? We mentioned to Goldman about this might be the next tactical trade, just given there has been signs of a rebound. Hong Kong Property, the HSP, has seen about 10% rise in the last 3 months. So it seems like this rotation into some of the property names, into financials, that continues on here, maybe out of tech once again. But you are seeing some pretty big moves when it comes to Sunan, China, Logan, the like.
Yeah, there we go. 53975346 is not my mobile number. Those are the two levels to watch on the Hang Seng Tech Index. The former is the support level that's held and the latter is the bear market level below which we will enter bear market territory. At the current level in Hang Seng Tech, we've taken out the first. We're just now 5 points above 53.46, which would take us into bear market terrain. Suffice to say, we've seen some pressure here on tech stocks. That's it from us here on The China Show. We'll see you all tomorrow.